Most people buy stocks just because the price looks cheap or because everyone else is buying. But price alone doesn't tell you if a stock is a good investment. That's where intrinsic value comes in. It gives us a reasonable estimate of what a company might be worth based on its earnings, growth, and how the market has historically valued it. Think of it like buying a business from a friend. You wouldn't just ask, how much are you selling it for? You'd want to check the earnings, the growth, and whether the price actually makes sense. In this video, I'll share the simple formula I've been using for over 6 years in my investing journey and how it has guided my decisions. So here's the formula. I first compute the future value, then get the present value, and then my buy price. Now, I know some of you came here just to grab the formula and skip ahead, but hear me out first. I'll explain why I use this method, break down each component, show you where to find the numbers, and how to apply it properly in your own strategy. And just to be clear, I didn't invent this formula. It's a simplified approach that Phil Town popularized in his book Rule Number 1, which itself is built on Benjamin Graham's principle of intrinsic value and margin of safety. The part I've adjusted is a margin of safety. I use 30% instead of the stricter 50% that Phil Town uses, and I'll explain later why. I like this formula because it's simple and practical. Unlike more complex models like the DCF, it doesn't require assumptions about interest rates, bond yields, or other variables. Instead, it relies on the company's historical performance and projects it forward, under the assumption that growth can continue at a similar pace over the next 5 to 10 years. So let's break down each component. The three main numbers you'll need are EPS, P ratio, and growth. The other parts of the formula, like raising it to the power of 10 or dividing by 1.10, are simply representations of the time horizon. If you only want to project for 5 years, just change those numbers to 5 or 7. But for me, I always use 10 years because that's how long I'm willing to hold the stock. EPS is just the company's earnings. You don't need to calculate this manually since most free websites already provide it. All you need is the current EPS, how much the company is earning today. Simple, no need to overcomplicate it. Next, the PE ratio. In this formula, I use a 5-year average PE. To get it, I take the lowest and highest PE over the past 5 years, then divide it by 2. This tells us how much investors are typically willing to pay for each peso or dollar of earnings. In other words, it shows how the market has valued the company over time. Remember, even if earnings grow, the stock price still depends on what multiple investors are willing to pay. That's why this part of the formula matters. It captures the emotional side of the market. Prices don't move only on fundamentals, they move on sentiment too. Now, how do you get this data? Websites like Simply Wall Street show historical PE charts, though the free version only lets you check up to 5 stocks a month. Amazon provides 2 to 3 years of history, which is already useful. And if all else fails, you can use the current PE ratio. Just keep in mind it's less reliable, since the market can be irrational in the short term. Looking at 5 years gives you a more balanced and realistic picture. Watch out for PE spikes. Sometimes the PE ratio suddenly shoots up very high for a short time, maybe because of hype, a news event, or even a pump and dump situation. If you include that inflated number as your highest PE, your average will also be inflated. That can make the formula spit out an artificially high intrinsic value, tricking you into thinking that stock is way more undervalued than it really is. That's why I filter out those outliers. If I see a spike that doesn't match the company's long-term trend, and especially if the ratio quickly fell back down, I don't count it as a true high. Instead, I focus on the range the stock has consistently traded at. The idea is simple. You want a realistic picture of how the market normally values the business, not a distorted snapshot from a short-lived frenzy. That's why looking at a full 5-year PE chart is much more reliable than relying on the current PE ratio. It helps you see the bigger picture and avoid short-term noise. Lastly, growth. This is where a lot of investors differ, and honestly, there's no single right answer. You can use whatever growth rate you're comfortable with. For example, some investors just use a conservative 5%. That may not reflect the company's actual growth, but it's cautious. Others set it at 10% or the industry average. Some people use ROE since it shows how much earnings the company generates relative to its equity or assets. In my last intrinsic value computation, I used a compounded earnings growth rate. Take note, this is different from the average earnings growth rate. The average can be misleading, especially if the company had a sudden one-time earnings jump in the past. That's why compounded growth is a better metric. It's simple to calculate. For example, if you're looking at earnings from 2015 to 2025, just take the 2015 EPS and the 2025 EPS and then apply the compounded annual growth rate formula. Some websites even compute it automatically. Just enter the two numbers and the number of years in between. Another approach is to use a sustainable growth rate formula, which is also straightforward. It's computed by ROE multiplied by retention ratio. The payout ratio is easy to get. Just divide dividends per share by EPS. So the sustainable growth rate is simply how fast a company can grow using only the profits it keeps, so profits it has left after paying out dividends. It's based on two things: how good the company is at making money on its equity, that's ROE, and how much of those profits it reinvests instead of paying as dividends. Think of it like this: ROE is the engine, and the retention ratio is the fuel. Put them together, you get the true speed the business can keep growing without borrowing extra money. So with that said, we've now explained every part of the formula. Let's put it into action. Let's use Costco as an example. This is Costco Capital from the Philippine stock market. By the way, I highly recommend using an Excel sheet for this. You can just copy the format I'm showing here. This way, you don't have to manually compute everything with a calculator over and over again. Once the formulas are set up, you just plug in the numbers and Excel or Google Sheets does the work for you. Here's how I type the formula in Excel. Just place the corresponding values in each cell as shown. You can pause the video here to set up your Excel sheet so it's easier to follow along. Step 1. EPS. This is straightforward. Costco's EPS is 1.43, and you can find this on any financial site like MSN, Investing.com, or simply Wall Street. Step 2. PE average. Costco's highest PE in the past 5 years was 6.7, which was December 2020, and the lowest was 3.9, which was in March 31, 2025. Add those together and divide by 2, and you get the 5-year average PE. Next step, growth rate. I'll start with my older method, the compounded or annualized earnings growth rate, because it's simple. Just be careful of one-off gains like you see. If the current year includes something unusual, it's better to use the long-term trend or the next or previous year. For Costco, 2014 earnings was 4.02, and 2025 earnings is 9.31. To get the annualized growth rate, you can use any online ROI calculator. Just set the dates correctly. Doing that, we get 8.76 annualized growth. Easy. You can also calculate this manually using the compound growth formula in Excel as shown here. If you're happy using the compounded growth rate, then you can skip the next part. Now let's also compute for the sustainable growth rate mentioned earlier, so you would have another option to use for growth rate. If you already know how to get the numbers, you can skip this step. But for everyone's sake, let's compute it manually. The formula is ROE multiplied by retention ratio. First, we get the payout ratio. This is calculated as dividends per share divided by EPS. Costco's total dividend payout for 2025 was 0.396. We divide this by 2024 ending EPS of 1.36. Why 2024? Because dividends are based on the previous year's earnings, not the current year. That's why we use 2024 EPS. You can find these numbers in the company's financial statements under the Income Statement tab, Diluted EPS, or on Simply Wall Street under the Dividends chart. Doing the math, we get a payout ratio of 29.11% or 0.29. To get the retention ratio, we subtract that from 1, so our retention ratio is 0.71. Then now we get the 2024 ROE as well. Easy enough, net profit divided by shareholders' equity. Net profit can be seen in the income statement, which is 9.31. Now go to the balance sheet, shareholders' equity, 100.40. So divided 2, you get 0.092 or 9.27%. That's our ROE. Then 9.27 multiplied by 0.71 is equal to 6.58%. That's our sustainable growth rate. It's a bit more conservative than the annualized growth rate of 8.76% we computed earlier. If you want a mix of the two, you can even go halfway and use something like 8%. That's what I often do. For me, the rule is to use whichever figure best represents the growth the company can realistically maintain in the years ahead. This is also the part where a lot of investors differ. Some blend their growth rates, while others lower them further to take a more conservative stance. For this example, let's stick with a 6.58% sustainable growth. So with all that, if you made your Excel sheet earlier, this is what you'll get. Present intrinsic value 5.53. Applying a 30% margin of safety, you get a buy price of 3.87. Why a margin of safety? Think of it like this. We are projecting or assuming that a company will grow at the same pace in the next 5 to 10 years as it did in the past. It's safer to be conservative. Just like engineers building a bridge, if they say the bridge's maximum load is 30 tons, that already includes a safety margin. In reality, the bridge might be able to handle 40 to 50 tons. Same concept here. The margin of safety gives you a buffer in case your projections are off. The percentage is up to you. Some investors use as low as 10%, but personally, 30% is my go-to. Now, as you can see, the buy price is much lower compared to the current stock price of 7.70. When I computed my buy price for Costco, I used the annualized growth rate because in my view, it better represents a company's actual growth trajectory. As I said, this is where a lot of investors differ. They use different growth assumptions. Some investors who have a strong conviction in the company choose to increase their growth rate, which leads to a higher intrinsic value. Others take a more conservative stance. Ultimately, it all depends on your research and understanding of the company. You have to strike a balance. Using higher numbers will increase your buy price, but it also means taking on more risk if your assumptions don't play out. On the other hand, using overly conservative numbers might lead to never buying anything, unless a major market crash happens. So finding the right balance in your assumptions is key. That's why, here's a final tip I want to leave you with. Use intrinsic value last. What do I mean by that? Assess the company first. In my quick checklist, I look at earnings growth, equity growth, debt management, dividends first. If I like the company based on those, then I compute its intrinsic value. Remember, just because a stock is cheap doesn't automatically mean it's a good investment. Why go straight to computing the buy price without knowing the business? That's how I approach it. Find a strong company, then pair it with a good price. So that's it with this video. By the way, if you want an easier way to get all the data for this formula, then I highly suggest Simply Wall Street, as they give you a complete 10 years worth of data, which is hard to come by on free websites, and they even have their own intrinsic value computation. And to make it easier, they have a stock filter so that you can easily scan for potential companies to add to your watch list. How great is that? So if you want to sign up, use my referral link below and you can get up to 50% discount. Thank you and see you in the next one.